Hey everybody, my name is Jake. Welcome to the channel. In today's video, I'm going to review 15 stocks that I have a close eye on. I'm going to share with everybody a few buys that I purchased here over the last couple of weeks, as well as share a few companies, a few stocks that I'm keeping a close eye on that I don't currently invest in, but I'm going to be considering here, as the year goes on and as we all experience this roller coaster here in the stock market. If you're new to the channel, I'd invite you to subscribe. I release educational videos on dividend growth investing every single Sunday. That's what the channel is all about. And really, when I address the audience in my videos, it's really I'm talking to newer or beginner investors that are really interested in growing passive income or cash flow through dividend investing. And that's what I share here on YouTube. Before I dive into the 15 companies that we're going to address or talk about in this video, I want to catch everybody up. If this is the very first video that you're watching here on my channel on YouTube, I want you to know kind of who I am and what kind of an investor I am. I'm a buy and hold investor. I invest for dividend growth. There's only very few times when I would sell a company or sell a stock, and that is in some cases, when a company cuts its dividend. Other than that, I'm looking to build long-term generational cash flow through investing into high-quality companies that have a competitive advantage, an economic moat, and really they're growing their business and they're rewarding me as a shareholder in the form of a growing dividend. I take a little bit of an unconventional route where I'm invested in just under 90 holdings. Some of these holdings, 5 of which are exchange traded funds, ETFs, but the remaining are individual companies. And I invest into companies like Altria Group, Wells Fargo, Disney, Aflac, and really across all sectors. And for those of you that are new to the channel, I also invest into real estate. I talk about that on my channel, so if you're interested in that, you can check that out. So really quick, this is kind of the mentality that I have when I'm investing. I'm investing into high-quality blue-chip companies that have a strong track record of dividend growth, and really that's what I'm focused on. And I want to point out that historical returns are no guarantee of future returns. We've seen that here with Boeing just recently. We've seen that time and time again with companies when they over-leverage, where they forget or they stop to innovate. And they're not keeping their eyes on what's going on. What's really going on, what's working today may not be working tomorrow. And in this video, that's kind of the perception that I have when I pick these 15 companies that I'm going to talk about today. That's kind of the approach that I'm going to be taking and really focusing on that. So the current sell-off that we're experiencing, we dropped 30% in just 22 days. This is the fastest sell-off of 30% in market history. So I really want everybody to kind of understand that as I'm talking about the companies that we're going to talk about, that the window of opportunity here is not going to be forever. Typically how it works in the market, you have a dramatic fall off followed typically within a 2-week time period, a massive correction in the other direction, right? So this video is not going to be addressing, okay, do I think this is a bottom? Is this a good time to buy? I think that's really something that you have to decide for yourself. But for me personally, I see this as a great buying opportunity. Okay, so for the remainder of the video, I'm going to break down all 15 companies in this kind of fashion, where I'm going to be looking at if you were to purchase the company on March 20th, February 14th, looking at the 10-year compounding annual growth rate. So this is the growth of the dividend, what that looks like for the company, as well as the payout ratio. The payout ratio is the net income that they're paying minus all expenses, the revenue, their net income that a company is receiving that they're paying out to the shareholder in the form of a dividend. And then the dividend growth, how many years has there been of consecutive growth? I'm also going to, touch on this as well, because this is also going to be really, really important. Very important, especially when we go in, we're looking at 2020, when a lot of companies are going to be cutting their dividend. So really pay attention to that, as well as if you were to invest or would have invested $1,000 on March 23rd compared to February 23rd, what would your return look like? And that's how I'm going to break it down. And I'm going to analyze this for all 15 stocks. And I've broken it down into 3 sections. The first section is going to be high yielders, companies that are paying over a 7% dividend yield, at least on, March 23rd. Now, at the time of this video, since then, in just 2 days, we've jumped up almost 15%. So keep that into consideration. The next section is going to be my buy and hold forever. These are companies that it doesn't matter how far they go down, what's going on in the market, I will always buy in and average into these companies. These are really my sleep well at nights, and buy and hold forever. And then the last section is going to be 5 companies that I'm kind of looking at that I don't have in my portfolio that I'm considering picking up and adding, whether it be to my M1 Finance portfolio or to another brokerage. I also invest with Vanguard, and when I want to make individual purchases, I typically either use Vanguard or Robinhood to do that. Okay, so the high yielders that I picked, the 5 here on the list. Now, I want to start off with saying how hard this was. There are so many great companies out there that are not only, in my portfolio, but outside of my portfolio that are currently yielding over 7% that I really would feel completely comfortable just adding them to the list here, but I wanted to keep it to just 5. And these are the 5 that I have in my portfolio and that I, want to highlight in this video. So the very first one is going to be Wells Fargo. If you purchase Wells Fargo on March 23rd, like I did, you would have gotten just over an 8% yield on cost with that investment. Now, if you were to invest into Wells Fargo on the 14th of February, your yield on cost would have been just over 4%. That's, pretty much cut in half from what you would have gotten on March 23rd. Now, in terms of full disclosure, I think this is very important. In my Vanguard account that I have, I make individual purchases. Now with M1 Finance, I would rather have M1 Finance leverage its own dynamic rebalancing and take advantage of that. And that is why I make individual purchases in my Vanguard account. And I purchased Wells Fargo on March 23rd. And the 10-year compounded annual growth rate, this is just the dividend for Wells Fargo, is just under 15%. And the payout ratio is just over 50%. I believe that a 50% payout ratio, yes, it's high, but you have to also understand you're getting an 8% dividend yield. And I think that this is very sustainable, at least for the short, at least for right now. I mean, who knows what's going to happen here throughout 2020 and what's going to go on. But for me personally, I feel comfortable with investing into Wells Fargo at this rate. Obviously, as you know, Wells Fargo cut its dividend back in the last financial crisis for obvious reasons. But for me personally, I feel comfortable investing into Wells Fargo at these rates. Now, if I would have invested $1,000 on March 23rd, I would be receiving over $80 in annual dividend cash flow. Now that is huge. That is what I want to highlight. So if you're putting in $1,000 into the broader market, you're not going to get anywhere near that. And that is why I invest also in individual companies, because the rate of return is just so much higher. Obviously, there's going to be higher risk that comes with that, but you're getting a much higher return for that. And if I were to invest $1,000 on February 23rd, I would have gotten $42 in annual dividend cash flow, which is also not bad. I mean, that's still fair. It's still good. It's still respectable, right? It's double what inflation is. So you're doubling, you're getting a much better return had you just put it into a conservative investment vehicle like a CD. And when I saw that Wells Fargo on March 23rd was yielding a current yield on cost of 8%, it really made me feel like this. And then when I went over to Seeking Alpha and where I got all the information, obviously for this video and everything that you're seeing here, when I went over to Seeking Alpha and I saw the yield on cost chart for Wells Fargo over the last 6 months, over the last 5 years, over the last 10 years, that Wells Fargo was, the last time that Wells Fargo was yielding 8% was back in 2011. It really got me feeling like this. You don't love me! Next on the list is going to be international paper. International paper is probably the riskiest, in my opinion, when it comes to all 5 of these here on the high yielders list. The reason why it's the riskiest is because they did not sustain their dividend back during the financial crisis. And looking at the payout ratio of 73%, this really is something that you have to keep an eye on. It's not something that I would put all of my life savings in, but it's something that, you know, as Kramer always says, your mad money, you could put your mad money in here. And, you know, if it goes down or if they cut their dividend, you know, this isn't something that you should be expecting to pay your bills with or something like that. This is something that you could invest in. And, you know, it's a high risk, high reward play, in my opinion. And if you were to invest $1,000 on March 23rd, you'd have just over $77. So not too shabby. I think it deserves a spot on the list. I was really considering switching out International Paper with 3M. Now 3M, obviously, you know, in my opinion, is a great buy, but just, you know, to kind of keep it, you know, fresh and unique here, I went with International Paper. So I don't want anybody in the comment section hating on me saying, oh, Jake, why did you put International Paper and not 3M? I obviously, you know, there's so many different companies out there you really can't necessarily go wrong with, but these are five that I think are really cash flowing machines and also long-term are great picks. The next on the list is going to be Altria Group. Now, Altria Group, all you know, things aside, when it comes to the social aspect of investing into sin stocks, I think as an individual company, as a cash flow machine, Altria Group definitely deserves a spot on this list. On March 23rd, dividend yield of just under 11%. On February 14th, just under 7.5%. With everything going on, Altria Group actually increased its dividend here recently. I think it's a safe play. Even with the payout ratio being over 76%, it is definitely a play or an investment that is safer, and I don't see them cutting their dividend anytime soon. As you can see here, they paid a consecutive dividend for over 50 years. Not only a consecutive, but a growing dividend over the last 50 years. On the list, Altria Group is going to yield you the highest return. If you were to invest $1,000 on March 23rd, you're going to get just over $105 in annual dividend cash flow. Next on the list is going to be AbbVie. AbbVie is yielding just right around 7% on March 23rd. Pretty big spike. If you followed AbbVie over the last couple of years, last year at least, you know, you've seen a great buying opportunity in 2019. Then it spiked up to like $95 just here towards the end of the year. And now it's seen a pullback, same with the broader market. Only 5 years of you know, compounded annual growth rate with everything that they had with Abbott. Payout ratio just under 50%. Dividend growth 6 years because of that, you know, with Abbott. If you were to invest $1,000 on March 23rd, you'd just get under $70 a year in annual cash flow. AbbVie is a great buy. I have it in my portfolio. I think it's a great pick. The next one is going to be AT&T. Now, there's going to be some haters likely in the comment section that, you know, AT&T was just downgraded, yada, yada, yada. I think, you know, as a high yielder, AT&T definitely deserves a spot on the list. On March 23rd, you were just getting just around an 8% dividend yield. Now, this is the highest it's been in over a decade. Pretty impressive stuff. Dividend growth of over 35 years. A lot of people are concerned about AT&T with their debt. I personally believe the way that AT&T is managed, that they're not going to cut their dividend. They're not going to cut their dividend. Yes, they're very well diversified, and that's one of the reasons why a lot of analysts are skeptical or bearish on AT&T is because they're so diversified. Kind of like, you know, with Disney, how they have kind of a footprint in so many different areas. I think that AT&T is going to be a sustainable company to hold on to. And I actually purchased AT&T in my Vanguard account. I made a purchase, and I shared this in my previous video. I'm still buying in and averaging into AT&T. I think it's a great buy at $27, $28, $29. I think it's an absolute steal. If you invested $1,000 on March 23rd, you're just getting under $80 in annual cash flow. So everybody, those are the high yielders. Now let's move into the buy and hold forevers. Now, once again, with these 5 companies, I am so comfortable, whatever the market is doing, whatever is going on, I'm going to be averaging into these companies. And in terms of full disclosure, I purchased all 5 of these in my Vanguard account, where I made specific purchases on March 23rd. Now, obviously, with those of you that follow the channel on my M1 Finance portfolio, where my portfolio is kind of on autopilot where I make weekly transfers, the portfolio also purchased smaller tranches, smaller positions of these 5 companies, but I made a little bit of larger, for me, you know, all of this is obviously relative, larger purchases for me relative to my portfolio and where I'm at. I purchased all 5 of these in my Vanguard account at individual prices. Not something that I typically do, but once again, we're not in normal times. The market does not normally go down 30% in a 22-day time period. So for those of you that follow the channel, you might be thinking, okay, well, why is he doing this? Where in M1 Finance, he usually does that. I haven't changed anything with M1 Finance in terms of like my weekly transfers, but with this opportunity, I am 100% taking advantage of this. So the very first one on the list is going to be Pepsi. Pepsi has grown its dividend for over 47 years. It is a dividend growth stock. If you would have invested $1,000 on March 23rd, you'd be getting $36 in annual dividend cash flow. The next on the list is going to be Coca-Cola. For those of you that know and follow the channel, you know that I love Coca-Cola. Coca-Cola is one of my all-time favorite stocks. It does have a little bit of a higher payout ratio. I know that some of their supply chains have been impacted by what's going on in the marketplace, not only here in the United States, but internationally. I still am sticking with Coca-Cola. I think it's a great buy. It's yielding over 4% currently. 57 years of dividend growth. I think really the only thing to look out for with Coca-Cola is that payout ratio. That's the only thing. I think, you know, even if it goes up to 80 or in the mid 80s, let's say fast forward, if I were to look into my crystal ball, let's say the market is in complete turmoil. I think even if Coca-Cola's payout ratio hit 90%, I would still be buying. And that would be okay with me, because I don't believe that this is going to be a long-term thing. That's why I'm fine with that. The next on the list is probably my very favorite stock of all time. Really kind of a toss-up, but this is definitely in my top 5 of all-time favorite stocks, is Waste Management. Waste Management is yielding just over 2.5% on March 23rd, compared to if I would have bought it on February 14th of 1.73. Dividend growth of 17 years, under a 50% payout ratio. Once again, this is a little bit of a lower payout ratio, but it is a dividend growth stock. It's a company that I can kind of wrap my head around. I've shared other videos on Waste Management in the past, but this stock, it's one of my absolute favorites. I can go to bed at night and feel completely comfortable that if the share price goes down, that's okay, but this is a long-term play for me. The next one on the list is going to be McDonald's. McDonald's saw a huge pullback. When I saw that it was $134 and dropping, I got really excited and I executed a trade right away. I've been following McDonald's for a while, been hoping for it to come down in price so that I can increase my yield on cost. And I took advantage of that here on March 23rd. It has a little bit of a higher payout ratio. I know with a lot of stuff that's going on, I think McDonald's is still a safe bet. I'm taking advantage of this pullback here. It's likely going to continue throughout 2020. I will continue to dollar cost average into McDonald's. Dividend growth of over 43 years. This is a stable company. I'm sticking with McDonald's. The last one here on this list is going to be Johnson & Johnson. This is, with Waste Management, really my favorite all-time stock. 57 years of consecutive dividend growth, a really healthy payout ratio of 42%. They're not going to cut their dividend. They're going to continue to grow. With Johnson & Johnson, they are so well diversified. This is one stock, you know, with all 5 of these, that I feel so comfortable with owning. Even when everything is in the red, the entire market is going crazy, I feel incredibly comfortable and thankful that I have capital that I can deploy into Johnson & Johnson at this time. So the last 5 here on the list, now in terms of full disclosure, these are not currently in my portfolio in M1 Finance, Vanguard. I only have a couple accounts. I have a Robinhood account, which just a few holdings, M1 Finance, which I share publicly here on YouTube, and my Vanguard account where I have my Roth IRA, an individual account where I make very, very seldomly individual purchases like I shared in this video. All 5 of these are not currently in my portfolio, but I am keeping a very close eye on and considering pulling the trigger of whether adding them. Most likely I would add them into my M1 Finance portfolio, except for the last one, and that's what I'm going to get to here in just a second. So the 5 that I'm talking about is, the first one is going to be MetLife. MetLife does not have a strong track record of dividend growth. However, they check off all the boxes apart apart from the consecutive dividend growth. They have a great payout ratio. They have a great 10-year compounded annual growth rate. They have an amazing starting dividend yield, just remarkable. And so everything else checks out for me. The only thing is really the consecutive growth. And that's not going to really, hinder me from making a decision on whether or not I want to scoop up MetLife. But I just want to let everybody know that, this is definitely an opportunity. I think this is a great company to look into, and I would consider adding to my portfolio here. Obviously, if I had the money today, I would add it and put it in there. But this is something that I'm keeping a close eye on. The next one is going to be ORI. Very similar to other holdings that I have in my portfolio in my insurance, my financial sector slice in my M1 Finance portfolio. I think this is a great one. It has a great track record. It's a dividend aristocrat of 28 years of consecutive dividend growth, a healthy payout ratio, a 10-year compounded annual growth rate of over 10%, a strong dividend yield, current dividend yield. I think this one checks off all the boxes, and really honestly, I could have this in my portfolio today, and it would make a great addition today to my portfolio. The next one is going to be American Express, AXP. This one I've been following for a while. It's just been so overpriced. It had the Warren Buffett price tag where pretty much every company that Warren Buffett invests in, except with the exception of maybe Kraft. I'll respect everybody that owns Kraft. I owned Kraft earlier in the year, but with American Express, it's been so high over the last couple of years that it's not been attractive to me. But now with this pullback, it's dropped about 50%, and it has a 2.5 yield, or at least it did on March 23rd. I know that it's jumped up here on the 24th and the 25th, but on the 23rd, it was looking pretty interesting. Great payout ratio, decent dividend growth rate, decent dividend growth history, track record. But yeah, that's what I'm looking at there. The next one here on the list. Now this is kind of a huge opportunity one. This is a high risk, high reward, is the Cheesecake Factory. Cheesecake Factory, when I was looking at it on March 23rd with over a 9% dividend yield, this was looking really, really good. The only thing is the payout ratio. Now, no one knows what's going to happen here in 2020. It could be that they go bankrupt. It's unlikely, but it is possible, right? Let's say that what's going on in the market right now continues, and worst case scenario, we are staying at home for months and months and months. I mean, these companies, they need, something's got to give, right? And so this is why it's a little bit of a high risk, high reward, but 9%, not too shabby. If you invested $1,000 on March 23rd, you're getting over $90 in annual cash flow. Not too bad at all. Okay, and the last one on the list here, this one is a little bit unique. As you can see here, this is not a dividend paying company. Now I want to share with you why I'm considering adding Berkshire B shares to my portfolio, not to my M1 Finance portfolio. My M1 Finance portfolio is a dividend growth portfolio. I'm considering adding it to an individual account like my Robinhood account or my Vanguard account, where I can buy in, just kind of invest in it and just kind of forget about it. The reason why is Warren Buffett is, before everything that was going on, before the market pulled back over 30%, Warren Buffett was sitting on over $128 billion in cash. And Warren Buffett, the guy, I don't know what it is, but he's got a head on his shoulder. I believe that Berkshire is going to outperform the market in 2021. Now let's kind of look back and see what happened in 2020. In 2020, Berkshire, for the first time in the last couple of years, Berkshire underperformed the greater market. And Warren Buffett got a lot of heat from shareholders that, okay, well, you're supposed to be the Oracle of Omaha. Why are you underperforming the broader market? Berkshire underperformed the broader market in 2019. I believe that Berkshire is going to greatly overperform. Okay, well, greatly in the sense of, I'm not going to predict anything, but predict anything in terms of like percentage points. I believe just generally Berkshire is going to overperform the broader market in 2021. And so what I'm considering taking a stake in Berkshire and holding on to it throughout 2021, and then taking the capital gains from that and then deploying them into a different dividend growth company. That's kind of the mindset that I have thinking about this. Once again, I have not yet added it to my portfolio. I don't own any shares of it, but that's kind of what I'm thinking of. Okay, if I were to invest in a Berkshire for the next maybe 1 or 2 or 3 years, and then take the capital gains from that and then deploy it into other dividend growth companies that are maybe at the time at a discount. That's kind of the thought process there. I haven't done it yet, but that's what I got my eyes on. So everybody, those are the 15 companies that I think that are really interesting here right now in 2020 that I'm keeping an eye on. Some of them are in my own portfolio. Some of them I'm adding more. I'm averaging in, whether it be in my M1 Finance portfolio or as we see the market pull back 30% in under a month, I'm making specific purchases. And I hope the information here was useful. Once again, I'm not a financial advisor, so don't take the information here as financial advice. Do your own research, but these are the 15 companies that I'm keeping a close eye on. Those are the 15 that I have on the list. Do you agree? Do you disagree? Once again, there's a ton of great opportunities out there. I'd be curious to hear what you're picking up, what you're keeping an eye on. And if you're new to the channel, I'd invite you to subscribe, like the video, and I'll catch everybody into the next video.